Hello everyone. I welcome you to yet another super interesting session wherein we'll be discussing top 10 stocks which are on my radar, which are in my watch list, and I'm studying those. Without wasting much time, let us go forward and understand each and every opportunity. As a disclaimer, let me tell you, Suyog Dhawan or Strategic Alpha, we are not SEBI registered investment advisors. So whatever shared in this presentation should be purely taken for educational purpose and do your homework before taking any investment decision. So this is purely for education purpose and in any manner it should not be considered as advice. So for what is a secret sauce of a multi-bagger? What is a secret sauce of a potential wealth creator? I have discussed it multiple times. Once I'm repeating that if we have these 5 to 6 points in our stock, then stock has a reasonable chance of becoming a long-term wealth creator. So number one is sales growth. Second is margin expansion because once the sales growth happens, the asset sweating happens, and if there is asset sweating, there is a margin expansion. And margin expansion, this all happens because of operating leverage. And once all the three things come together, there is a free cash flow generation. And with that free cash flow generation, company is able to reduce its debt if there is any debt because when the company is debt heavy and there are no free cash flows earlier, it is highly likely that the stock will be languishing and it will be beaten down from the top levels. So debt reduction and free cash flow generation and then high PS growth. We have seen in multiple cases where if the sales doubles, profit more than doubles. So high EPS growth because your operating margins go up just because your sales has doubled, the margins go up even 50% or 60%, but the profit might go up 3 to 4 times. So when the sales double, profit will more than double. So high EPS growth and led by valuation expansion because when the company is right now which is having stagnant sales or stagnant margins or low margins or trading at a lower capacity utilization, usually the company will be trading at low valuation to its historic highs. And when all these things come together, it helps a stock to expand its valuation. So all this put together, if we find in any stock, it has a reasonable chance of creating wealth over 1, 2, 3, or 5 years, and it can become a multi-bagger. So let us go forward and understand each and every business, understand each and every opportunity. So first, number one is Arvind Fashions. Arvind Fashions operate in branded apparels, beauty and footwear space. It has a portfolio of several owned and licensed global brands across different segments. So what are the key aspects of Arvind Fashions opportunity? So it's a first of all, Arvind Fashion is a special demerger opportunity because it got demerged from Arvind Limited, and there is a detailed video on YouTube which I posted some 6 8 months back. It is already available on YouTube. You can check that video on Arvind Fashions. But since the video was posted, the fundamentals have improved a lot. I posted that video in August last year, and currently the fundamentals have been on the upside, and it's been everything is going in the right direction for Arvind Fashions. So it's a special situation demerger opportunity because the stock listed at highs, and just because just after the demerger, a lot of people think that we are getting this stock for free. A lot of retail investors. So once it went up and it came down from 800 rupees to as low as 150 rupees. So it's a demerger opportunity, and whenever the demerger happens, coupled with there is if there are bad sentiments in market, what happens is the stock unnecessarily takes a beating, and Arvind Fashions in the same fashion came down. Second is fundraising. Company has raised around 860 crores in past 1 year, and it intends to accelerate its growth by focusing on its core high conviction brand. They have sold non-core brands and they are just focusing on core brands, high growth. Management has guided around 15% revenue growth for FY23. Deep undervaluation. Stock is deeply undervalued, arise due to demerger. AFL was previously, just before the demerger, Arvind Fashion Limited was valued at 7,700 crore by M&A critic just before the demerger, 7,700 crore. And even after all those positive, because it was a loss making company then, and today it's a profit making company. Operationally, it is profitable. Even on net basis, from past 2 quarters, it has turned profitable. And it is currently trading at a market cap of just 3,200 crore. So it clearly says that it is deeply undervalued compared to what it was in pre-demerger period. So debt reduction, company has reduced its debt from 2,164 crores in FY20 to around 958 crores in FY22. So it is more than 50% debt reduction has happened in Arvind Fashions. Coupled with high brand recognition, it owns brands like Sephora, Arrow, US Polo, Tommy Hilfiger, and all these brands are well-known brands. If you just look at Nika and compare it with Arvind Fashions, you will get to understand that Sephora is much better brand than whatever the brands are available on Nika. So it has high brand recognition and company has turned profitable. It has moved from loss to profit. It has turned profitable in past 2 quarters from an operating loss of 100 crores per quarter. Now they are doing the operating profit of 70 to 90 crores. And will be a big benefit from FMCGization of its product because earlier, what used to happen just 10 years back, if you just look at how clothes were purchased by people, most of the people used to purchase it only on Diwalis. Now, the product it has begun its journey as the income levels have gone up for the country. Most of the people are purchasing twice and thrice in their in 1 year, and which I call it as FMCGization. So if it is going to happen going forward, also it is going to benefit Arvind Fashions, which is deeply undervalued today. So all this put together, Arvind Fashions becomes a great opportunity to study in these tough times, especially when we in past 1 2 months where we have seen most of the small and mid cap stocks fall 40% from the top, 50% from the top. Even Arvind Fashions has fallen 32% from the top. So this is a great opportunity to study Arvind Fashions, and it has all the ingredients of a potential wealth creator, which we discussed earlier. Sales growth, margin expansion, debt reduction, deleveraging, operating leverage, and valuation expansion because it is deeply undervalued today. As the market rewards, as market will recognize its true potential, the valuation expansion will happen in future. So this was number one, Arvind Fashions. Number two is Atul Auto. So Atul Auto, the video is already available on YouTube channel. You can check that. Atul Auto manufactures and sells auto rickshaw in domestic and overseas market. So what are the key aspects of Atul Auto opportunity? So unless and until we have that five secret sauces, I have not brought those stocks into this list. So let us understand the key aspects of Atul Auto opportunity. So it's a leader in auto rickshaw segment. It has high operating leverage because they have an installed capacity of 1,20,000 auto rickshaws, manufacturing 1,20,000 auto rickshaws per annum. And currently they are just producing like 20,000 auto rickshaws per annum. Just because there were very tough period for auto segment. The already video is already available on YouTube channel. You can go through that.
So Atul Auto has a high operating leverage because their production capacity is 1,20,000 and currently they are just producing 16 to 20,000 kind of thing, kind of auto rickshaws. And the debt to equity is comfortable at 0.58 times because debt to equity is very much important whenever you assess an opportunity. And most of the capacity expansion which they did was from internal accruals. They have not taken much debt to expand their capacities. Most of the capacity expansion they have done through internal accruals. All the products are present across all the spectrums. Take it LPG, take it CNG, take it electric vehicle, take it petrol or diesel. They are present across all the spectrum. And going forward, wherever the demand emerges, they can calibrate themselves and increase the production of the segment which is in the most demand. So that is the biggest opportunity for Atul Auto, presence across all spectrums. Then there is a huge market opportunity for Atul Auto. Most of the African countries, they are at that stage where we were 20 years back. So it's a great opportunity for Atul Auto to export their products in all the segments. Even if there is a great opportunity for electric vehicle in India, but in African countries, it's a great opportunity to sell your diesel engine rickshaws and petrol and all other fossil fuel products. So there is a huge export market opportunity. Stock is deeply undervalued because just few years back, I'll just show you the chart. Currently, the market cap of this company is just 372 crore. If you just look at sales to market cap, if you just look at price to book, company is just few years back was trading at a price to book of 5.6, and currently it is trading at a price to book of 1.5, 1.2, 1.3, 1.4, that kind of price to book, which says that it is deeply undervalued. Apart from that, even if you look it from the market cap to sales perspective, in 2014 it was trading at 18 times its sales. Market cap to sales ratio was 18 times, and currently the market cap to sales ratio is 1.2 times, which shows that it is deeply undervalued. Even if you look at from the price perspective, the stock went on to become a mega bagger. This was the period when Vijay Kedia made multi-bagger profits, and since then the stock is languishing. And this happened because from past 4 5 years there has been bad period for auto, and auto has gone through all the bad times, and it is once again ready for green shoot in the economy. So deep undervaluation, and it is the stock which will be, it is a company which will be benefiting from school reopening, because as and when the school reopening and all those things are starting now, it is going to be a biggest beneficiary of that theme, reopening theme. Next company comes SJS Enterprises. So SJS Enterprises is one of the leading players in Indian decorative aesthetics industry in terms of revenue. It offers design to delivery aesthetics provider. It is an aesthetic solution provider with ability to design, develop, and manufacture a diverse product portfolio for a wide range of customers in automotive and consumer appliance industries. So key aspects of HJS. So what they do is they produce these decals, they produce these logos, they produce these design elements for a bike, for a car, even if you have something like a nameplate and all those. So it's in niche business. It's a niche category business. So key aspects of SJS opportunity. First, number one, it's a niche business model. Number two, its management has guided for 25% revenue growth for FY 2023 and 30% PAT growth for FY 2023. And currently the capacity utilization, once again, the secret sauce of a multi-bagger, it is trading at a lower capacity utilization of 42%. So which means without any capacity expansion, they can bring the revenues, they can double the revenues in next 3 to 4 years. And management has clearly said that the revenue growth expectation for FY 23 is 25% and PAT growth expectation is 30%. It's a debt-free and cash-rich company. High margin business, 30 to 35% is the operating profit margin for this business, and 18 to 20% is the net profit margin. It is a company which will benefit from the auto industry upcycle. Even though from past 5 6 years, auto industry has been in the bad times, still this company was able to deliver 15 to 20% revenue growth, 15% revenue growth, and a strong profit growth, which means that they were able to gain market share in these tough times. So when the industry will turn going forward, because when there was flat, no industry growth, still they were able to grow. When the industry grows, they will be able to grow higher than the industry growth. Even if we think that the industry growth will be 15% going forward because of the low base effect. I have explained that low base effect in Atul Auto video, which is available on YouTube channel. You can go through that. There is a HDFC, there is a DSP mutual fund presentation in that video wherein they have talked about low base and high growth coming in future. So even if we expect 15% growth for auto sector for the next 3 to 4 years because of low base effect, this company can grow its revenue at 20 to 25%. And management themselves have told that expectation for FY23 is 25% revenue growth and 30% PAT growth. So and one of the biggest advantage of this business is they have long standing relationship. Most of their clients are more than 10 years old. You can go through the investor presentation of SJS Enterprises. You'll be able to understand that most of their customers are more than 10 years in relationship with them. So if I just want to open the screener, so HJS Enterprises, it's a recent listing. It is trading at a multiple of 25 times. Just look at return on equity and return on capital employed, because this is not a case. Yeah, this is a case of lower capacity utilization, but still ROE and ROC is high. The reason for that is high margins. Just look at the chart. So the stock got listed at around 470 rupees. It's a recent listing, and after that, once again, it is trading at 420 rupees. If you look at the revenue growth, so from past few years, FY17 the sales was 180 crore. In FY22 they have reached 268 crore. Profit which they were doing of 39 crore, which they are now doing a profit of 52 crore. So this is the case. Now, if you look at the holding shareholding pattern, most of the biggies are holding this stock. Axis Mutual Fund, Franklin India, smaller companies, Mirai Asset, Aditya Birla Sun Life. So there is a huge mutual fund holding in this, 18%. So this was about SJS Enterprise. Next company which is on my radar is HDFC Asset Management Company. Why I am liking this company? Because HDFC Asset Management, let me tell you about that company first. HDFC Asset Management is promoted by HDFC Group. They own around 52% share, and Standard Life, which owns around 21% share in HDFC Asset Management, and it is the largest AMC in India with total asset under management, which is equivalent to which is equal to 4 lakh crore as on December 2020. After that, there has been growth in their AUM. Company offers a large suite of savings and investment product across all asset classes. It's also into portfolio management, and they have other services for HNI family offices, domestic corporate trust, provident funds, domestic and global institution. What is the key aspect? What are the key aspect of HDFC Asset Management opportunity? First, number one, reputed HDFC Group. We have seen all the stocks of HDFC Group have created wealth for its shareholder in long run. If you have seen that. Number two, it's dynamics of asset management companies, dynamic of AMC business. So asset management companies, as I always say, that they are safer than banking and financial business. The reason for that is asset management companies are cash generating machines. Why do I say so? Asset management companies matlab mutual fund companies. You give your money manage to your fund manager, mutual fund manager, and through their mutual fund schemes, they take all that money, charge you on annual basis around 2.5% on an annual basis, means 2.5% divided by 365 on a daily basis. It gets adjusted to your NAV, and they get consistent cash flows. There is no need of debt here, because in case of bank, they give out the loans, and if the money doesn't come back, it's a big risk for a bank. Even in case of insurance, if they have provided the insurance on the premiums, if large fatalities happen, just like COVID and all, most of the insurance companies might face loss. But this is a business wherein you give your money for them to manage, and out of that, they will charge you 2.5% on a annual basis, deducted on a daily basis, and it's a cash generating machine. They don't need to raise any debt and all those things. So this dynamics of asset management company makes this business a very safe business than banking and financials. I have posted that earlier also. So this is why I like HDFC Asset Management, and it is trading at the lowest valuation since listing. It got listed in 2018, and it is trading at lowest valuation since its listing. And one thing which I like to find is one of the hated stocks. So HDFC is asset management is one of the hated stocks now today, because in past 3 years it has not delivered anything. In past 3 years it has not given returns anything, and mean reversion is imminent. If you want to know what is mean reversion, I have written a special blog on mean reversion. The link of this blog will be shared in the description. Apart from that, even if you go through my blog, there is a blog, you can just search mean reversion. You'll get to understand why I'm saying that HDFC asset management can be a great opportunity going forward. Mean reversion is imminent. It's a play of financialization of savings. Even today, the equity penetration in India is very low. For the next few years, 5 to 10 years down the line, or even 3 5 years down the line, we will see that the equity penetration might rise to as high as 7 to 10%. So with that, this is a clean beneficiary of financialization of savings. So let me just share the numbers screener.in with you. So why I'm saying, so HDFC Asset Management Company, it is trading at a market cap of 39,000 crore. Why I'm saying that it is trading at the lowest valuation since listing. So if you just look at the PE ratio, it got listed in August 2018. The PE ratio of the stock was 50 times. It went to as low as 34 times, and it went to as high as 63 times. Currently, the price which it is trading at a P ratio of 26. If we look at the price, so price, it got listed at around 1700. It just went up to 1900. It made a low of around 1200. From 1200, it became a multi-bagger, and it recent means in November 9, 2019, it reached a high of 3700. Currently, it is trading at 1800. So it is higher than the earlier price, but the P ratio is low, which means that even at this price, it is less expensive than earlier. The reason for that is the profits have grown, and because of which, for P ratio to come down, either profit have to grow or the stock has to go down. So in this case, both has happened, but profit have grown higher than 2019. If you just look at the numbers in FY 2019, they did a profit of 913 crore, 31 crore. Today they are doing a profit of 1393 crore, which means because of which P ratio has gone down. Even though the price has not broken, means touched the earlier lows, still the P ratio is low. So this says that it is trading at the lowest valuation since its listing period. So that's why, and even promoter holding is good, 68%. So that's why I like HDFC as asset management company. So next opportunity is IDFC Limited. So IDFC Limited was incorporated in 1997. It is a non-banking finance company regulated by Reserve Bank of India. It continues to hold investments in IDFC First Bank and IDFC. So this the AMC they recently sold. So currently they are just owning investment in IDFC First Bank. Currently they are owning 36.6% stake in IDFC First Bank Limited. So IDFC is a business that earlier they were holding IDFC Mutual Fund, and along with that IDFC Bank. Currently they have sold asset management business to Bandhan Bank at 4,500 crores, and IDFC is holding now 36% stake in IDFC First Bank, which is valued at 8,800 crore roughly. Post IDFC means IDFC mutual fund, whatever they have sold, they might garner around 4,000 crore after paying taxes, because they sold it at 4,500 crore. Even after paying taxes, they might get around 4,000 crore from the asset sale of IDFC AMC. So some of the parts, if we just add 8,800 crore, if you give even 30 to 30% discount, holding company discount, the value of IDFC First Bank will be around 6,800 crore, and HDFC Asset Management cash deal around 4,000 crore. So total value, I'll be totaling it at around 10,600 crore. But current market cap of IDFC Limited is just 8,400 crore. It is lower than that, which says that there is a clean margin of safety of 25% in IDFC First Limited stock. So who should bet on IDFC Limited? A person who is bullish on IDFC First Bank only should bet on IDFC Limited, because there is a possibility in future that IDFC will be reverse merged with IDFC First Bank, and for every one share of IDFC Limited, people might get 1.4 shares of IDFC First Bank. That is the possibility, because there is a clean discount. IDFC Limited owns 1.4 shares in IDFC First Bank. This, if you just do the calculation, and you should look at IDFC, you should study IDFC only and only if you understand IDFC First Bank opportunity. I have made a detailed video and I have posted a blog on IDFC First Bank way back, some few years back, 1 year back. I have made a video that is available on YouTube channel. Apart from that, there is a blog which I posted 2 years back, which is already available on blog. You can read that blog, you can understand the IDFC First Bank opportunity, and why I say that IDFC First Bank is a bet on a jockey and not on the horse. Jockey means the person who is running the bank, which is V. Vaidyanathan. The horse is the business, IDFC First Bank. So it's a bet on jockey, not on the horse. V. Vaidyanathan. It's a bet on V. Vaidyanathan's capability to create world-class bank. So I have posted that already. So you can go through that, you will understand. And why today, the reason for that is first 4 years, IDFC First Bank was struggling because of the merger which they did with IDFC. Capital First did merged with IDFC, but it took them 3 to 4 years to come out of that mess. And hereafter, there is a possibility of 25 to 30% loan book growth, and which is a high possibility. If you just go and check recent management interview of V. Vaidyanathan, he is now first telling that there is a possibility of 25 to 30% loan growth. CASA ratio is at 50%. It is having industry bets net interest margin, not even as high as, means they have surpassed the net interest margin compared to HDFC Bank, Kotak Bank. They have the highest and second best after Bajaj Finance. So IDFC First Bank is a great opportunity in that way. So you can study about it. Next business comes is Shankara Building Products. Shankara Building Products is one of the India's leading organized retailers of home improvement and business building products in India. It caters to a large base spread across various end user segments in urban and semi-urban markets through retail-led multi-channel approach. Few aspects about Shankara opportunity. It has a first mover advantage. I have already posted a video on YouTube channel. You can go through that. Why I say that Shankara Building Products is a DMart of building products. So if somebody would have got an opportunity to enter DMart way back in 2006, it would have created massive wealth. Even after listing, it has created wealth. But if somebody would have got an opportunity to be a part of DMart in 2006, when the number of stores were less than 10 or 20, it would have created huge wealth. Same opportunity we have in Shankara Building Products. The reason for that is number one, it is a first mover advantage. It is the only company which is selling its building product material through organized retail, and it's a huge opportunity, because if you see the market opportunity, Shankara Building Products currently is just owning 1% market share. So there is a great opportunity for Shankara Building Products to garner the market share from unorganized sector, because unorganized sector is having more than 95% share in the current business, the segment which Shankara Building Products of is present. So it's a proxy to real estate play. If somebody is bullish on real estate, should be naturally bullish on Shankara Building Products, because it's a company which provides home improvement segment, home improvement products, steel, angles, and all those products which real estate construction needs. It has comfortable debt to equity. If you just look at the numbers, I'll just show that. So it has comfortable debt to equity, experience management, more than 15 years of experience in the same segment. And recently, why I become bullish than earlier? Because this, after I have started studying Shankara Building Products, it has tripled. And when I bought my first stock, it has tripled since then. But even today, I have not yet sold it, and I have become super bullish today. The reason for that is APL Apollo has picked up 10% stake in Shankara. And we have seen that how APL Apollo has created the wealth. And Mr. Akki, you must go through the video on Shankara Building Products, which says that they don't have the connections with retailers. They don't have connections with the retailers. They have connections with plumbers. They have connections with paint people and all those things. So they are having that business model, and the business has already delivered. It is not that they are not doing any profits and all. Number of stores have increased, number of profits have increased, all those they are working it, and they are doing it, and they are making it possible. If you just look at the Home Depot, which is in Canada, which is in Australia, if you look at the business model, they have become the leaders. And it's not a business for 6 months or 1 year. It's a business for 5 to 7 year time horizon, when the industry itself will change itself, and most of the organized retailers will make the move in here. And APL Apollo has picked up 10% stake, because earlier I was saying that Shankara Building Products promoter seems to be very trustworthy. But the thing is, promoter is not yet aggressive. This is what I thought. But after APL Apollo's promoter, Mr. Gupta, who has picked 10% stake in Shankara, it changes the whole landscape for Shankara Building Products. The reason for that is Mr. Gupta is heavily aggressive, and that aggressiveness will naturally come down to Shankara Building Products today. This tie-up is a win-win for both the companies. So reasonable valuations, it is trading at beaten down price. If we just look at the numbers, I'll just show the numbers. So Shankara Building Products, it is just trading at a market cap of 1,500 crores compared to the big opportunity. And as I have explained in my Shankara video, it qualifies all the criteria of Vijay Kedia's SMILE framework: small in size, extra large potential, market potential. You can understand that. Shankara Building Products is trading at a market cap of 1,500 crore. It is trading at 46 PE. PE is always misleading, as I say. Don't go at looking at the PE, because this is past. You must look at the forward PE. So Shankara Building Products, this is where I posted the video on Shankara. It has already doubled since then, and this is when I first bought it. So I'm scaling it up. This was considered to be DMart of building product. Just after the listing, the stock has came down from 2,200 to as low as 200, just because the growth trap. A lot of people bought it at a higher valuation. That's why I always say that one must not buy at high valuation. The PE of this company at that time, when the numbers were good, it was trading at 72. Just today, the PE of this company is 46, because there is, compared to that earning, the earnings have fallen. So naturally, the PE ratio will go up. But if you see actually in future, if you look at the future earnings, it is trading at 20 times earnings. So this was a period when the management was aggressive. The sales went up from 1,400 crore to 2,000 crore in 2016. And this was a period when they brought, means they looking at this growth, 20, up to 2018, they brought this IPO, and IPO looking at this margins and sales figures and all those things. Market was considering this as a demand of building products. But growth did disappoint for this company, because just after the and I always say that why one should not bet in long IPO for long term. The reason for that is IPOs are already always brought when they are at the peak of their financial thing, because everyone who thinks that yes, I am doing something great in the business, that is when the people bring IPO. But everything is cyclical, as I have explained, that the after 2018, just because of rapid expansion and all those things, the margins got hit, and there were a lot of stores where they were not performing, and it took them 3 years to close down the stores which were not performing. And once again, the margins have started going up, sales have started going up now first, the margins might expand in future. So all that is present in annual report. You can watch that, read that annual report. Profitability is started improving from 14 crore to 34 crore now. And shareholding pattern, 52% promoter holding. So let us go forward and understand. Next company is from defense sector. The name of the company is Apollo Microsystems. Apollo Microsystems is a corporation that specializes in electrical and electromechanical engineering design, manufacture and distribution. The company designs, develops and distributes high performance mission and time critical solutions to defense, space and homeland security of Ministry of Defense government, control power, public sector undertakings and private sector. So this is what the business is. And I have written a blog on defense sector. Hope you have gone through it, because this is 1 month back. I wrote a blog on this, and it is available on 30th April. I have written a blog on Indian defense sector and analysis, and I have posted the opportunity which India has, budget 2022 onwards, a move towards Atmanirbhar India, and all those things are available. The defense budget is on the rise since last few years, and since the Ukraine war, it has become much more important for our country to spend more and manufacture in India. That is one of the biggest points which recent budget had, and it has a great opportunity for all these companies. But especially I'm focusing on this company, Apollo Microsystems, and I have written this blog on our Strategic Alpha blog. You can go through that blog. Next, so what is the special key aspects of Apollo Microsystems opportunity? The key aspect of Apollo Microsystems opportunity is big import substitutions theme. More than 80% of our defense requirement we are importing right now, and there is a huge opportunity for Indian manufacturers to follow make in India, and there is a huge opportunity for import substitution. And Apollo Microsystems is a small size company but having a big market potential. As Vijay Kedia says about smile philosophy, it qualifies all those criteria. Rich promoter experience, comfortable debt to equity, and deeply undervalued. The company is trading at just one time sales. If you just look at the numbers on screener, so Apollo Microsystems current market cap of this company is just 269 crore. And see, stock is available at beaten down prices, because as I always say, never why should you should not touch IPOs. But I like after 2 to 3 years after IPO, there can be a great opportunity. I have posted a blog on that, why one should stay away from IPO, and I also posted a video on anatomy of IPO, where for a long-term investor, if one understand that anatomy, one can spot great opportunities when they will be getting right valuation. So Apollo Microsystem got listed at around 400 means around 400. The stock came down to as low as 45 rupees. Currently it is trading at 117 rupees. So it is available at a beaten down price. Now let us look at the numbers. So stock is trading at 0.84 times book value. Debt to equity is very comfortable, 0.36. Promoter holding is 59%, which shows skin in the game. Then recent quarter, if you are able to see this, they have posted lifetime highest revenue, and this is just the start for that, because This is when just few quarters back only government has started providing more orders to Indian manufacturers in defense, and there is lot of development happening on defense space. So 105 crore revenue, this is lifetime highest revenue, and I feel this is just the start. They are doing the operating profit margin of 15%. Once again, we have seen in past that they can do a operating profit margin as well as high as 27%. So this is median, this is mean. On a higher side, they can do a margins of 26%. So currently they are doing a profit of 15 crore. So here the secret sauce of a mega bagger, as I said, that if they are doing a sales of 100 crores, last year they have done a sales of 243 crores. If they are able to maintain this run rate, they have a possibility to double their sales in next 3 to 4 years. Because 100 crore into 4 quarters, it is pretty evident that they can do a sales of 400 crores. From around 200 crores, they will be able to double their sales. If you just see here, in 2016, they were doing a profit of 10 crore on 150 crore sales, and 2019 they were doing a sales of 263 crore. Profit went up from 10 crore to 29 crore. So profit, just because the sales has doubled, profit has more than doubled. This is a possibility going forward also. So here is, and debt to equity, as I said, borrowings are only 115 crore, which is very comfortable. So promoters own 59%. So all that, everything is available in this opportunity. Trading at just one time sales. If you just look at the other defense stocks, most of the defense stocks are trading at 3 to 4 times sales. So it's a hidden gem which many people have not discovered. Apollo Microsystems can become great opportunity to study. So Apex Frozen Foods, next opportunity is Apex Frozen Foods. So Apex Frozen Foods is an integrated producer and exporter of shelf stability, stable quality aquaculture products. Apex Frozen Food is leading producers and exporters of processed shrimp, and it began its production in operations in 1995. I've made a detailed video on Apex Frozen Foods. I've posted that on YouTube channel. You can go through that. The company's operations comprise hatchery, farming and pre-processing, processing and exporting shelf life, shelf stable quality aqua products like shrimp. So key aspects of AFF opportunity, what are the key aspects? Number one, it's a niche business. Not many people are in this business. There are only 4 to 5 companies in this business which have such kind of revenue. Number two is operating leverage. They have a capacity to produce 100, but currently they are just producing 42. There is a huge room, and most of the capex it is already done. Capacity expansion is already done. They don't have to spend on capex now. And whenever the opportunities arises for them to export more, because there were tailwinds from past 1 year for exporting, because the shipping costs were very high. Now the shipping costs have started coming down, and once again they can focus on export, because biggest cost for shrimp export is shipping cost, and shipping cost have started moderating and once again started coming down. So it has a high operating leverage. Currently, as I said, that they are just working at 42% capacity utilization. Whenever the demands will come back, they can work as high as 95% capacity utilization. Just few years back in 2018, they have done that and they have worked at 95% utilization levels. So without doing anything, whenever the demand comes back, they will be able to double their sales over the next 3 to 4 years. At least in 2 to 3 years, they will be able to, 3 years at least, they will be able to do double their sales. So first expectation which we want from a wealth creator is high sales growth and doubling the sales. That is possible in Apex Frozen Foods. Next is rich promoter experience. More promoters has been in the same business from past 20 years. Comfortable debt levels, even after all those expansion and all those things, the debt level is very comfortable. And most of the capex has done from internal accruals here in this case also. Deep undervaluation. Just after the listing, stock became a multi-bagger and it has got so once again it is the case of looking at the business after 3 to 4 years of IPO, because that is when no one is looking at. And I like to buy one of the hated stocks in stock market. The reason for that is that's when you get a great discount on valuation. The reason for that is when you can create alpha, and you have to be a lonely path of wealth creation if you want to create wealth. If you just buy just when the stock, when where everyone is buying, you cannot create alpha. If you want to have wealth creation like 2x, 3x, and 5x, you need to buy something when no one is touching that. So deep undervaluation available at beaten down price, and there is a possibility of sales expansion, margin expansion, and expansion in future. Let us look at the numbers. So Apex Frozen Foods, it is trading at 820 crore market cap. Sales which they are doing is 900 crore. That too at a capacity utilization of 42%. If the capacity utilization rises as high as 95%, the sales will be around 1,800 crores. And we have seen in past also, if the sales doubles, profit more than doubles. So they can do a profit of 100 crores in whenever the capacity utilization happens like 95 to 96% in future, they will be able to do a profit of 100 crores in future, because margin expansion will also happen. Promote holding 72%, which says that high skin in the game. So this was all about Apex Frozen Foods. Now let us move forward with the next opportunity, which we are going to study is care ratings. So care ratings, the last opportunity, the 10th opportunity which you should study is care ratings. So care ratings is a leading rating agency in India, and it provides various credit rating that helps corporate to raise capital for their various requirements and assess the investors to form a investment decision. They give the opinion whether the debt instrument is serviceable or not, what is the credit rating, and all those things. What are the key aspects of care opportunity? I have written a detailed blog 2 years back on care ratings. You can go through that blog to understand this entire opportunity. So key aspects of care opportunity, the beauty of this business model is that it doesn't require any capex to grow the revenues. All that they have to do is hire an MBA, pay him ₹1 million, and do a business of ₹1 billion, because they will read the balance sheet and they will just give the rating and all, understand the valuation, they will just give the rating, which might help the company to get lower interest rates and all those things. So even during the IPO they have to do this rating and all. So this is a great business. Pay $1 million and do a business of billion. High margin business, typically credit rating agencies around the world are in a north of 50% margins. Hardly we will find any businesses with such margins. Few of the businesses like Crisil, they are doing a margin of operating profit margin of as high as 70% plus, net margins of around 40-45%. This is a company which is a debt free company. Care Ratings enjoys debt free status, which makes this a money making machine with no outgoes on interest. Cash rich, the company Care Ratings has cash and cash equivalents of 360 crore, which includes investment done in mutual fund, cash at bank, and bank deposits. Operates in oligopolistic market, as when I was discussing about Bombay Stock Exchange some few years back, when it was trading at 400 rupees, it went on to become 10 times. It was in a duopoly market, and the stock was beaten down. It was available at 400 rupees, just after adjusted for split, pre-adjustment for split, it is now trading at 4,000 rupees. Post split, I think it is, I don't know current price, I think 900 rupees or something. So this care is working in oligopolistic market, wherein Care Ratings, Care, Crisil, and ICRA are the only three companies which controls all the rating business in India. And I have written about why rating business is such a business, because this is a business. One can argue that these are the businesses, some here they have done some bad things in past. Care Ratings, IL&FS crisis happened because of Care Ratings. But even in USA 2008 times, most of the subprime crisis happened because of care rating agencies of Moody's and S&P. But these are the important factors in the economy, and you cannot close down this business just because they have given the wrong opinion about the debt status. So they will give some fine, they will slash some fine on these companies, but the business as usual goes up. And in future, they do this great business in future. This is what we have seen in past 20 years of history of all the world's credit rating agencies. So I've written a detailed blog. It was written in 2020, March 2020. You can read this blog. So care rating blog, I've given all the aspects, what happened in past, because of which stock came down from as high as 1700 to as low as 300 rupees. All that I have shared here in this care rating blog. You can go through that. So care ratings, as I said, it is trading at 1300 crore market cap, 1378 crore market cap. And out of that, 364 crore is a cash on balance sheet. If you just deduct for that, because it's a debt free cash rich balance sheet, there is no debt, nothing. So it's a debt free cash rich balance sheet. If you just deduct that cash out of the current market cap, you are getting third largest rating agency in India at just a market cap of 1000 crore deducted for cash. Book value of this company is 200 crore. If you just compare with other companies, they are trading at 10 times book. But Care is trading at just 2 times book. Crisil and ICRA, they are trading at higher than 10 times book. So return on capital employed and return on equity is very comfortable. Debt to equity is, it's a debt free company. Market cap to sales is 5 times. So if you just look at the P ratio, it is in 10 years of its history, it is trading at the lower band. In its 10 to 15 years of 12 years of history, it is trading at the lower band. And the reasons are obvious, because there is a reputational damage for care rating in past, because they were the culprits in IL&FS crisis. But as the time passes, people forget about all those things. You can see about read that blog. Even that same happened with S&P rating agency in US. If you just look at the history of US, so see, this is a Moody's share price. So 2008 was the time when Moody's got slashed due to fines. The stock came down 65%. But after that, people forgot about that, and stock became a multi-bagger. From 19 USD, the stock went up to 250 USD. Same in, even if you see S&P 500, so these also got slashed during 2008. The stock went up from 20 USD to 294 USD in 10 years, 10 times in 10 years. So this was S&P, this was global business, and same, there is not much difference I'm seeing in care rating business in India. But there are risks. We must understand that. As I said, that company is almost debt free, and it is doing a sales of 250 crore today, and it is a play on credit growth in India. Past 10 years is the period when we have seen very less credit growth, 5%, 3-4% credit growth in past 10 years. This is a time when the credit growth will once again start. There are few reports on this credit growth in future. That is the reason why I am liking IDFC First Bank, because in 3 years itself, their loan book growth can grow from 1,27,000 crore to as high as 2,50,000 crore in 3 years. And if the loan requirement is going to increase, because last year just budget, government has spent highest for capital goods segment, and they want to reverse. So the debt issuances will be higher, which has not happened in past 10 years. So when the debt issuance will go up, the business for care rating will go up. And I am seeing that the sales can double in future because of two reasons. Low base, because of reputational damage in past few years, there has been a low base, sales growth has not happened. Just but few months back, they have done their brand revamping, and that can help them to grow the sales. So sales can double from here. And if the sales doubles, we know earlier they were doing a operating profit margin of 69%. Just because they are in reputational damage today, they are selling it their products at a discount, and they are just doing a margin of 32%. Is there a case, we must study that, is there a case that the margins will go up from 32% to as high as 69% or even 50% in future? If we get that answer, then care rating becomes a great opportunity to study. So this was all about all the 10 opportunities which I have discussed with you.